Coaching revenue is lumpy, and if your personal pay is lumpy in the same shape, the variance lands in the coaching room as much as in your bank account. January is 2,000, pipeline thin coming out of the holidays. April is 12,000, 3 new long-term clients signed and 2 retainers renewed. Draw proportional to what came in, and February is anxious, April is overconfident, and neither is useful when you're sitting across from a client. The discipline is to treat yourself like an employee even when you're sole prop. The mechanism is simple. The behavioral effect is the load-bearing part of the unit. 2 months, January at 2,000, April at 12,000. And you can already see the personal pattern that follows. February, you're checking the bank balance daily and rehearsing what to cut from the household budget. March, you're saying yes to a client you'd normally screen out because the money pressure is dictating the decision. April, the 12,000 arrives, and the relief makes the next month's planning feel easy in a way that won't survive May. The revenue lumps weren't the problem. The fact that you transmitted the lumps directly into your personal account was the problem. The smoothing system breaks that transmission. The core move is to treat yourself like an employee. An employee doesn't get paid more when the company has a good month. They get paid their salary on the regular schedule, regardless of whether the company billed $2 million or $200,000 that month. The company holds the variance internally and the employee's life stays stable. As the owner-operator of a coaching practice, you can replicate that pattern. Pay yourself a consistent amount on a regular schedule. Let the business checking account hold the variance. The reserve account from Module 6.4 stays separate and protected. Your personal account flatlines. Most coaches who run this discipline can name the month they started it. The reserve-feeds-the-paycheck pattern is 4 steps, and it's the same whether you're sole prop or S-corp. Step 1. Client payments land in business checking exactly as they do today. Step 2. On every deposit, a fixed percentage transfers automatically to the tax reserve account from Module 6.4 plus Module 16.2. The tax money never sits in checking long enough to feel spendable. Step 3. On a fixed schedule, 1st and 15th or monthly, a fixed draw transfers from business checking to personal checking. Step 4. Business checking acts as the buffer. High months build the balance. Low months draw it down. The reserve and personal accounts stay stable through both. The reserve percentage is protected because it comes off the top before checking balance accumulates. That ordering matters. If you wait until end of month to compute the reserve transfer, the visible balance in checking has already shaped your sense of what's spendable, and the reserve almost always gets shorted. If the reserve comes off automatically on every deposit, the balance you see in business checking is already net of taxes, and your perception of available funds matches reality. The personal checking transfer then runs on its own schedule against the net of taxes balance. Whether the draw mechanism is a manual transfer for sole prop or a W-2 paycheck for S-corp, the discipline is identical. Setting the draw rate is a 4-step methodology, and it doesn't take long once you have the data. 1. Pull your last 12 months of net revenue, or project the next 12 if you're newer than a year. 2. Find the 25th percentile monthly revenue, which is your 3rd lowest month if you have 12 data points. That's your floor, the level you can sustain through a bad month without panic. 3. Multiply the floor by 80%. That gives you cushion for the truly slow months, and that number is your safe, consistent draw rate. 4. Revisit quarterly. Raise it as the business grows. Hold it steady through temporary dips. Lee is a composite of the most common feast or famine pattern, and the bracket math here is psychological, not financial. 2 years solo. Revenue swings between $3,200 and $11,000 a month. She pays herself whatever's left in business checking at month end. Some months that's $8,000 to personal. Some months it's $1,800. The 8,000 months she spends like the practice is finally sustainable. The 1,800 months she panics, and the panic produces the move that costs more than the cash shortage itself. She takes a wrong fit client, or she keeps a client past the right exit point because she can't afford to lose them. Lee, after the methodology, is the same coach with one operational change, and 3 months later, nothing about the business has changed. 25th percentile month from her trailing 12, 4,800. 80% of that, 3,800. She sets the recurring draw at 3,800 on the first of each month. Same total dollars to her account over any quarter. Different distribution. 3 months in, business hasn't changed, but the feast or famine signal into her personal account has stopped. 18 months in, she describes the smoothing discipline as the single operational change that most impacted her coaching work. She's not the only coach who has said that to me. This is a coaching decision before it's a financial one, and that framing is the part most coaches miss. Inconsistent owner pay creates personal financial instability that bleeds into client selection. The wrong fit client you should have screened out gets taken on because the slow months put pressure on the decision. Overconfidence in good months produces spending that has to be unwound in slower months, which produces stress, which produces the same compromised client selection from a different angle. Anxiety in slow months degrades presence in the room. The smoothing discipline protects the work. The frame here is coaching performance expressed through the pay account, with budgeting as a secondary benefit. Before you close this unit and move to Module 12, set the number and schedule the transfer so the discipline runs itself going forward. Open the Owner Pay Smoothing worksheet. Enter your last 12 months of net revenue or project the next 12 if you're newer. The worksheet computes the 25th percentile month and the 80% floor. Take that number, set it as your recurring draw, schedule the transfer in your business checking on the cadence you picked back in Unit 11.1. Come back in 90 days and check the business checking balance. It should be buffering, building in good months, drawing down in slow months. If it's not buffering, the draw rate is set wrong and you recompute.